I get asked, what happens if I get my offer accepted with the seller and then I submit a loan application and it doesn't go through? Am I just stuck with this property? So let's talk about this in detail. So first and foremost, one of the biggest mistakes that investors make is they find properties before they find the money. It is completely Bass-Ackwards because lenders are going to want to lend on certain things and not on other things. And you need to know what your lender is going to lend on and what they're not going to lend on. Now, if you're just going out to buy a house for your family and you're going to go to Wells Fargo or Bank of America or whatever and get a loan and get an FHA loan, yeah, that's pretty similar. But even then, the seller wants to know you've already been pre-approved for the loan before they go under contract with you. So they're going to see a pre-approval letter or something like that. Investing is no different, but it's a little more complicated because if you're trying to invest and get little to no money down, then you are going to be working under a different set of parameters because most lenders won't do that, especially hard money lenders or private money lenders. So the ones that will, like us, have some guidelines around that. So what happens is you want to know what your lender can do to get in with as little money as possible, and then go find properties that they're willing to lend on under those parameters so that you're getting a property that will actually work for the program that they have. So let me just back up here just a little bit. The way that I learned this lesson was because early on in my real estate investing, there weren't a bunch of hard money lenders, private money lenders. There was basically Guidos in the back of the alleyways. And so what would happen is I would spend a ton of time trying to find a property. I would research, I would take months, I would make lots of offers, and I would end up getting a property under contract. So then I had a couple of people that I would call. Hey, I've got a property under contract. Do you want to finance it? Well, I never knew what the interest rates would be, the points would be. I never could work up and know what they were going to charge, if there was monthly payments, like none of that, how much down they wanted. I didn't know any of those things because they changed those things depending upon who called, when they called, and what was happening with their available capital. So I never knew that. The other thing I didn't know is what they wanted to lend on and what they didn't want to lend on, because if there was something in the news or a city had a robbery or something like that, then they'd say, no, I'm sorry, I don't want to do a loan in that area. The problem with all that is I just spent 6 months of my life and a lot of time and headache getting this property under contract to then find out that the private money lender doesn't want to do it. You don't want that to happen. So what you do is you get pre-approved first. You then find out what are the terms that are necessary. One of the things that we do is we put together a advanced deal analysis. The advanced deal analysis is a software that pulls all that information in so you can see how profitable it is, what the costs are going to be. When it comes down to it, there's a risk versus reward. The less money skin into the game that you put, the higher you're going to pay in points and interest. The more you're willing to put in, the less you're going to pay in points and interest. So it really just depends. It's this teeter-totter of, how much cash, your experience, how many you've done, how much cash that you have, how much the property is, how much the rehab is, all that different types of stuff. And then this is cost. So the more you have of that, the less the cost is, and the less you have, the more the cost is. It's just like that teeter-totter that we're dealing with here. And so that's the thing. Well, that's always changing. That's dynamic based upon the property, based upon your individual circumstances, maybe credit. So although we can lend regardless of your credit, we are looking at those things to help determine costs. So the better those things are, the less that you're going to pay, which is actually a great thing because then as you improve those, you'll be paying less and less and less. And the longer you stay in our program, the less you're going to be paying as time goes on as well. One of the benefits of being here with us. Now, you need to understand what the lender will lend on, what they won't lend on, which is exactly why we've spent hundreds of thousands of dollars building our advanced deal analysis software so you will know that. So don't go shopping unless you have the money. Get the money and then go shopping. You don't want to go to the store and fall in love with a shirt to come back and ask your dad if you can get the money for it. And they're like, no, I'm not going to give you the money for that. You want to know you've got the money in your pocket. So you do that by finding your hard money lender, getting pre-approved, understanding what they like and what they don't like. You need to understand these are the things that we like. These are the properties we like. Go find those things. Because if you're going to find properties that we don't like, you're going to have a much harder time with us being able to finance that, which is exactly why we put the advanced deal analysis together, which is exactly why you have access to that anytime to put those deals in and to look at those. Okay, so that's kind of the first thing. So one, make sure you're pre-approved. Make sure you have a lender. Make sure your hard money lender, you know what your hard money lender likes and doesn't like. Most hard money lenders can't do that because they haven't spent the money to put a software together that's going to help you with those things, and they're not constantly updating that. So you kind of get the big surprise. So if you don't want to have the big surprise of, I'm sorry, we can't do that, then you're going to want to make sure that you're working with a lender that has these tools and resources, get pre-approved with them, and finding properties that meet the criteria that they are interested in funding. That's the number one tip. So you find the money, then you find the property. You don't go shopping at all until you have the money and you know what you're actually looking for. So if you're doing that, that solves half the battle. A lot of people go out and try and find a property, and then they find out no lender wants to do it, or the lender wants a ton of money down, or whatever the case is, and then they're like, well, what do I do with this property now? Well, if you've written your contracts appropriately, you don't need to worry about that either. And this is what I mean. Let's say you make an offer to buy the property for $200,000. Okay. You are already pre-approved. You use the proof of funds letter to help get it under contract. And you've got this property under contract for $200,000. Now, to do that, you probably should have used our advanced deal analysis, which basically you're putting all the numbers in. It's going to tell you how profitable it is. It's going to tell you all the costs that nobody thinks about, like property taxes or transfer taxes, if they're applicable in your area, or utilities, or everything that everyone forgets that costs a lot of money, all comes down, title insurance, all that type of stuff comes down and says, hey, this is about how profitable this property should be. Now, that is based upon two really big assumptions. That is based upon the after repaired value of the property, and you are determining that. It's also dependent upon the rehab costs, and that is also something that you are plugging in. Okay, so you plug in the ARV and you plug in the rehab cost. Based upon that, it's going to say, here's the profit margin, and you go and get that property under contract. If you've gotten the property under contract and you did the ADA, you did the proof of funds, and you were already pre-approved, then you're going to have a much easier time that property moving forward, because you're looking for the properties that we're interested in. You've gotten through this process, and you know you're going after properties that are going to meet those criteria. But that doesn't always mean that it's going to work out. So then what happens is, once you go under contract, then you're going to do a loan application. It should have that information stored because you've already done the ADA and you're going to do your loan application. What happens at the loan application time is it's time to start validating things. So one of the first things that's going to happen is a desktop value. That desktop value is going to look on the computer, and they're going to say, hey, you know what? You were thinking the property is worth $300,000. We can only find comps for $275,000. Why did you think you could sell it for $300,000? We can't find any comps in that area. Or they may say, hey, we actually think that you were under. We think it's more like $320 because we've got these comps and that type of stuff. Now, there's a whole process in determining what can be used as a comparable, what can't be used as a comparable. But as a matter of speaking, you're looking for sold properties. The lower of sold or active properties that are within typically a 1 mile radius, but you want to make sure you're not going after natural boundaries. We've got all kinds of training on valuing properties. You're going to want to check that out. Now, a video is put together so you can see that, so that you can understand, because this is part of the process of learning. You learn by doing. So let's say that you thought it was worth $300 and the desktop comes back and says, hey, we think it's only worth $250. What they're going to do is show you all the comps, and they're going to ask you, hey, what comps did you use and why did you choose those comps? Now, that may be where you're saying, oh, man, I made a mistake. Well, if you made a mistake, if you wrote your contract properly, you put in there a couple of deadlines. Number one, you put in an inspection and evaluation deadline. Number two, you put an appraisal deadline. Number three, you put in a financing deadline. Okay, so if you go to that and the values don't come in where you want, as long as you remove yourself from the contract prior to this appraisal deadline or this inspection deadline, then you get your earnest money back and you walk away from the agreement. Now, if you're getting close to one of these deadlines, you need to extend, which means everyone agrees to a new date, or you need to remove yourself from the contract so that you can get your earnest money back. So let's give this example. Let's say that the desktop comes in and it's $250,000. You look at that, you look at the comps and say, oh man, I made a mistake. This is really only worth $200,000. I need to remove myself from the contract. Well, what I recommend you do is negotiate before you remove yourself. So you say, hey, you know what? I can't buy it for $200,000, but I can buy it for $175,000. We can close quick. We can do all that type of stuff. So that's something you're interested in. Negotiate, show them why, and maybe you can end up with a deal that way. And if not, remove yourself from the contract, go find another one, and use this experiential knowledge that you're gaining as going through the experience to help you on the next one, so you're one closer to getting a deal that's going to work. After the desktop is done, then what happens is the scope of work. So a virtual walkthrough is then scheduled. This virtual walkthrough is with you, the general contractor, and our project manager. So our project manager is going to be attending that virtually through the camera. The idea with this is that we're walking through the property as a team and determining what has to happen so this property will sell for the price that we think. Let's just say it ends up, we were 310 and you thought it was at 300. What we're doing is we are looking at all of the comparables that sold for 310 or in that range, and we're saying, okay, what does this property have that our subject property needs to have in order for it to sell? This may be, hey, we need granite countertops. All these have granite countertops. We've got to have granite countertops. It could be all these have tile. We've got to have tile. Or it could be it's all vinyl and there is no tile. We don't need to spend the money to do that. So we want to be comparing what our finished product will be like, needs to be like the three comparables that we're using in justifying the value that it is. So it's really easy to know what work needs to be done to the property. You simply look at what has already sold and you determine your scope of work based upon that. This also gets in with quality of workmanship, meaning are you putting in granite or are you putting in vinyl? There's a difference there and there's a price difference there. You don't want to put vinyl in if you really need to be putting granite countertops in, because that's what the market is demanding for that price range. So with that, you'll be walking through the entire property and putting a scope of work together. The project manager will be assisting in doing all of this and saying, okay, guys, here's our scope of work. Then there's a meeting where that scope of work gets outlined. There's a pricing meeting with the general contractor where they come up with all those prices. And then once that's done, then you know how much the rehab cost is going to be. Well, let's say that you thought the rehab was going to be $50,000 and it actually ends up being $60,000. You're going to have to go back and renegotiate, or you're going to have to pull out before your inspection's deadline. So you need to get this number from your contractor with the project manager, all of that done before your evaluations and inspections deadline, so you can get your earnest money back and you can either renegotiate or you can pull yourself out of the contract and you can go do it again. Now, again, this whole concept of going through and doing the virtual walkthrough and determining the scope of work and determining those prices is also something that can help you in your experiential learning. We also don't leave you stranded. We give you everything you need to understand the values and the desktops using our software and our other services so you can do that. We also give you everything you need in determining construction prices. Even if you know nothing about construction, you can go through and make the selections and it's going to give you an idea of pricing on that. So you shouldn't be that far off. If you are, you renegotiate or you pull yourself out of the contract. But if you're pre-approved and using the proof of funds and using the ADA and using the software to come up with the values and using the training to come up with the values, values, and you're using the software to come up with a scope of work and what needs to be done, and you're using those comparables, then you should be seeing the same thing that we're seeing, right? We're looking at the same information, and we're looking at the same property, we're looking at the same values, we're looking at the same scope of work, and we're looking at the same comparables. So this is what our property needs to look like. We all should be seeing the same thing. So if there's a reason why this deal couldn't go through, it's probably because you missed something. Either you missed something in the value, or you missed something in the rehab costs, or there could be some weird factor where, like, the property has an oil tank on it, or there's some environmental issue. Those are very, very rare, but occasionally they do come up. So that's how you make sure that you're in line. Now, what happens if you get through this entire process and for some reason the loan can't go through? Are you just stuck with a property? The answer is no. As long as you remove yourself from the contract within the deadlines that you established when you made your offer to the seller, then you can walk away from the property, get your earnest money back, and you can walk away. You have no responsibilities, no obligations. But that's a lot of work. Now, are you going to have to do this probably several times before you get a good deal? Yes, because you have to learn through the process of doing this. But if you are pre-approved and you do the proof of funds and you use the ADA and you use our software, our Investor's Edge software, in determining the values, doing the full research and using the methodology that we use, if you use our rehab costs and you have a good idea of the scope, you're going to have a much higher likelihood that this is going to move forward than it's not going to move forward, which is why we go through this entire process. And as you do it, you get better at it, you learn from it, and we all improve. Now, if you go through this process and for some reason it doesn't work out, which is typically going to be because you mislooked at the ARV or you mislooked at the rehab cost, something happened there, the first thing we do is try and renegotiate the price because the seller still has the problem, right? There's more work to be done with this property than you thought, Mr. Seller. Here's all the work that needs to be done. This is what I can buy the property for. And don't give up on it. Just because they say no today doesn't mean they'll say no forever. I had a property that I still own today that I chased for 2.5 years. I probably made 4 or 5 offers over that 2.5 years, and it's one of the best properties I have ever purchased. So you want to stay with it. You don't want to give up on these things. But all in all, if for some reason the loan can't go through, as long as you are removing yourselves before these deadlines or extending these deadlines if necessary, then you walk away, go find another property, and you go through this process again so that you're better the next time. But this will cut down drastically in having those situations where the deal just doesn't work out. But it really comes down to the ARV and the rehab costs are typically where most mistakes are made. And let's be real, you're going to have to make some assumptions and then you go and validate those. You don't want to spend all the time and the money to validate the full rehab costs until you actually have it under contract. And that's why we use our softwares and our tools to get us to this point. And then we do an in-depth look to make sure that it's going to be a good deal. And then we move forward with the closing. I hope this is helping you. So if you submit a loan application and it doesn't go through, it's going to be because we're going through this process. You're not stuck with the property as long as you remove yourself from the contract within the deadlines. I also have a great video on earnest money deposits and how to set those that may be helpful for you as well.